The Fed explained. The Federal Reserve is our central bank and is considered to have a dual mandate. Their mandates are maximum employment and price stability and moderate long-term rates. When inflation rises, it creates an environment where there is a lack of price stability and interest rates do not remain moderate for the long term. So the Fed jumps into action. It has a few tools at its disposal to manage the volatility, but we're gonna focus on the federal funds rate. This is the interest rate at which banks and other depository institutions lend money to each other, usually on an overnight basis. When the Fed raises these rates, it makes money more expensive for banks to borrow. When money is more expensive for banks to borrow, it becomes more expensive for them to lend. That excess cost trickles down to the consumer in the form of higher interest rates. The Fed has 8 regularly scheduled meetings per year, where they determine what they'll do with respect to the economy and interest rates. Lastly, after each meeting, the president of the Fed will hold a press conference and detail the reasoning behind their decisions. And even throughout the year between the meetings, we'll see press conferences about the Fed's outlook on the economy. That's why we know that the plan is for interest rates to continue to increase to stifle demand and combat inflation. But eventually, maybe in a year, maybe in 5 years, the money supply can be greater than demand, and the Fed will likely start to decrease rates to stimulate the economy once again.